Imagine this: you are pouring every ounce of your energy into building your dream business. Long nights, relentless effort, calculated risks. And then, one morning, you get a letter from the IRS. Your heart drops. Audit. The word alone is enough to make any entrepreneur feel an immediate sense of panic. But here is the truth: an audit does not have to be your worst nightmare. It is not random. It is not personal. It is triggered. There are patterns, behaviors, red flags. And once you understand them, you can not only protect yourself, you can also run a business that is cleaner, sharper, and more resilient. So, if you think audits only happen to people who cheat on taxes, think again. Many honest small business owners get caught in the net simply because they do not understand how the system works. Today, you are going to learn what those triggers are, how to avoid them, and what to do if the IRS comes knocking. Let us start with the first painful truth: high-income businesses are more likely to be audited. You might think the IRS is only focused on billionaires or people running shady operations, but in reality, they zero in on small business owners who report higher than average earnings. Why? Because higher income generally means higher potential for underreported revenue or misclassified deductions. If your business consistently shows 6 or 7 figures in profit, but your tax filings do not align with typical industry standards, it sets off alarms. The IRS uses complex algorithms to compare your returns to others in your field. If your numbers fall far outside the expected range, you become a target. This does not mean you should underreport income to fly under the radar. Quite the opposite. You must document everything, keep precise records, and work with a professional who understands your industry standards. The more accurate and transparent your income reporting, the lower your audit risk. Another red flag that triggers audits is inconsistent or excessive deductions. Many entrepreneurs fall into the trap of thinking that anything remotely related to their business is deductible. Meals, travel, home office expenses. While many of these can be legitimate, abusing them is a fast track to IRS scrutiny. If your deductions seem inflated compared to your reported income, you are sending a signal that something might be off. For example, claiming $60,000 in travel deductions on a business that made $90,000 in revenue is going to raise questions. The IRS will want to know why your expenses are eating up nearly all your income. Be especially cautious with categories like entertainment, vehicle use, and meals. These are some of the most commonly abused deductions, and therefore, among the most scrutinized. Keep detailed logs, save receipts, and avoid estimating. The IRS does not take kindly to guesstimates. If you cannot prove it, do not deduct it. One of the silent triggers of an audit is cash-heavy businesses. If your business operates primarily in cash, think salons, restaurants, car washes, or some types of consulting, the IRS considers you high risk. Why? Because cash is easier to underreport and harder to trace. If your deposits and reported income do not match, or if your lifestyle does not reflect your claimed earnings, it raises suspicion. The IRS may conduct a lifestyle audit, examining things like your home, vehicles, vacations, and credit card usage. If your spending habits do not align with your reported income, they will dig deeper. The best way to protect yourself: move away from cash wherever possible. Use traceable payment methods like credit cards, bank transfers, and accounting software that tracks every transaction. Create a paper trail that can be audited without fear. If your numbers match your lifestyle, you dramatically reduce your risk. Another common trigger is misclassifying employees as independent contractors. This is an area the IRS watches closely because it affects how taxes are withheld and reported. If you have workers who operate under your direction, work full-time hours, and use your equipment, but you classify them as contractors, you may be inviting trouble. The IRS has clear guidelines on what constitutes an employee versus a contractor. Misclassification not only triggers audits, but can also lead to hefty penalties, back taxes, and even legal consequences. If you are unsure, consult with a CPA or employment attorney. It is always safer to err on the side of compliance than to cut corners and get caught. Many small businesses misclassify workers to avoid payroll taxes, but the short-term savings are never worth the long-term cost of an audit and penalty. Let us talk about home office deductions, another massive audit trigger. It is tempting to write off a portion of your home as a business expense, especially if you are working from your living room or spare bedroom. But the IRS has very specific rules. To qualify, your home office must be used exclusively and regularly for business. That means no using it as a guest room, gym, or playroom. If you are deducting part of your home without meeting the strict criteria, you are waving a red flag. Even if your home office qualifies, you need precise measurements, photos, and documentation. Use tax software or a professional who understands how to calculate the correct square footage. Keep a floor plan and track expenses like utilities, mortgage interest, and repairs proportionally. When done correctly, home office deductions can save you money. When done carelessly, they can bring the IRS to your door. Here is another silent killer: round numbers. If every deduction, income figure, or expense you list ends in a zero, it signals that you may be estimating instead of calculating. The IRS knows most financial data does not neatly in multiples of 100. Real businesses have messy numbers: 74323, 198.67, 12, 34895. If your tax return looks too clean, it looks suspicious. This is especially true for cash-based deductions or personal expenses that you are trying to write off as business-related. Instead of rounding, take the time to calculate and report exact figures. Use software that tracks down to the penny. Not only does this show accuracy, it also demonstrates to the IRS that you take compliance seriously. In a world where so many people cut corners, precision is your protection. If you have multiple years of losses, that too can trigger an audit. The IRS understands that new businesses take time to become profitable, but if your company reports a loss year after year, they may begin to suspect you are using your business as a tax shelter. The general rule is that if you report a net loss in 3 out of 5 consecutive years, it increases your risk of audit. They will question whether your business is a hobby or a legitimate venture. To protect yourself, you need to show intent to make a profit. That means keeping a business plan, marketing strategy, and records of client acquisition efforts. Show that you are investing in growth, not just using your business to write off personal expenses. The more legitimate your efforts look on paper, the more credibility you have if questioned. Late or amended tax returns are another common audit magnet. Filing late, especially without a proper extension, puts you on the radar. So does amending your return multiple times within a short period. While amending a return is your legal right, doing it frequently raises questions about your bookkeeping and whether you are being entirely truthful. If you realize you made a mistake, absolutely correct it, but do it carefully and with documentation. And if you are habitually late, it is time to get organized. Put tax deadlines on your calendar, work with a CPA, and avoid last-minute scrambling. Timely and accurate filings reduce your risk and build a reputation of compliance. Now let us say you have done everything right, but you still get that audit letter. What do? First, do not panic. An audit does not mean you are guilty. It just means the IRS wants more information. Respond promptly. Ignoring the letter will not make it go away. It will only escalate. Gather all documentation related to the year in question. Receipts, invoices, mileage logs, bank statements, payroll records. Work with a professional, either a CPA or a tax attorney, who can speak the IRS's language. The biggest mistake people make is trying to handle audits alone. IRS agents are trained to find inconsistencies, and a single misstatement can lead to more issues. A professional helps you navigate the process strategically and ensures you do not say or submit anything that could hurt your case. And if there is one thing every entrepreneur should do starting today, it is this: schedule a yearly tax review with a certified professional. Not during tax season, but midway through the year. Let them review your income, deductions, and record-keeping habits. Catch mistakes before they become patterns. Ask what you can improve before you are forced to defend it. When it comes to audits, the smartest business owners are not the ones who never get audited. They are the ones who are always ready if they do. If you found this breakdown helpful and want to stay 2 steps ahead of the IRS while building your business with confidence, check out the next video where we reveal the most overlooked tax strategies that high-income entrepreneurs are using right now.